better to just have 7. But most texts will say 5: revenues, expenses, assets, liabilities, stockholders' equity. This 5. 1, 2, 3, 4, 5. Yes. Okay. Now we can go back to our question. And the shortcut I'm talking about is that you pick each of these accounts and you label them according to which element they fall into. So accounts payable, payable, that means it's a liability, right? Accounts receivable, that is money that someone is owing you. That's an asset, right? And this is an expense. Cash is an asset. You just label them. And what that does for you, let me show you what I've done here. See how I've labeled each of these accounts. What that does for you is that you can go back to your equation and say, okay, the first statement I'm preparing is the income statement. Income statement is net income, is what I need to get, equals revenues minus expenses. So I have to just go to what I have labeled and just list all the revenues. This is the only R, revenues. This one is RE, retained earnings. For revenues, list it. I only have one. Only one of these is R when you look at it. Revenue, list it. Net income is revenue minus expenses, right? So look at all the E's, all the expenses. 1, 2, 3, 4. 4 expenses. List them. You see that I only have 3 here. That's because income tax expense cannot come here. But I will explain why. So you have your revenues, you have expenses, and then you just subtract your expenses from your revenue, and that gives you your income. Now, that should normally be net income, but remember that our nation collects taxes. Almost every nation in the world collects taxes. So that's an expense. Income tax is an expense. But we don't put it together with other expenses. Why? Because in most situations, you don't know what the income tax expense is yet until you prepare this report. So usually we don't know what it is. We will have this figure, 3,020. Then there will be a tax rate that has been given by the IRS or by the government, depending on which country. And then that tax rate, you multiply by this difference in revenue and expenses, and that gives you your income tax expense. So normally you have to calculate it. In this question, we are given, so we can just plug it in, but don't make the mistake of putting it under this section, because normally you should have calculated it. So we're fortunate enough, we don't have to calculate, we are given. So that's why we call this income before tax. In most reports you won't see income before tax, you see earnings before tax. It's called EBT. And where there is interest, you have EBIT, in earnings before interest and tax. But in this case, we have EBT, earnings before tax. And then we have our income tax expense, which is given to us. This is it. E, 780, income tax expense is given to us. Mostly, you have to calculate it. And then you deduct it, and you have your net income. So our net income in this case is positive. That's why I put this note here. Tax is calculated. But in this case, we are given, we use what we are given. $2,240. Good. People are usually tempted to go to the balance sheet next. We've prepared our income statement. The second financial statement, the balance sheet, people are tempted to come here first. But I will advise you, as you walk on in your accounting journey, don't prepare your balance sheet next after the income statement. What do you prepare next? A statement of retained earnings. Why? Because this retained earnings figure, whatever you get as your ending retained earnings, is what should come to your retained earnings year. So instead of you preparing your balance sheet, getting to this point and having to use calculator to calculate your retained earnings, why don't you? I did all of this in Excel, so I didn't bother using any calculator. But why don't you prepare your statement of retained earnings first, immediately after getting your net income? Because that's the only thing you need. Dividend has been given to us. We have our beginning retained earnings. We can calculate our ending retained earnings. I know I put June 30 here. That's just a mistake. It's December 31st. So that means you have this beginning retained earnings plus net income minus dividend gives you ending retained earnings. And then we can take this figure and then we can come and prepare our balance sheet. Remember, I've labeled each of these according to whether they are revenue, expenses, assets, liabilities, or stockholders' equity. So, good. Since I've labeled them, all I have to do is just look at where's an asset? Where are my assets? Balance sheet is assets equals liability plus stockholders' equity, right? So I can just go, okay, first asset. And then I pick everything that has A in front of them. Apart from this, you can only pick one cash. Remember, and this balance sheet is at December 31st. So because it's at December 31st, we don't use the first one. We use the ending cash balance. And so cash, 10,600. Accounts receivable, that's another asset. We list all the assets. We total them. Assets equals liabilities plus stockholders' equity. So we need to do our liabilities. And we can just pick anything that has L. Accounts payable, notes payable, together, those are your liabilities. And then stockholders' equity, and then that's SE. What are the things that have SE? SE. Let's see. Common stock is here. S. Common stock, 15,100. That's this. And then retained earnings. This is dividend. We've used it in calculating ending retained earnings. We just need the ending retained earnings. We've used this up. You can't just pick this. We need the ending retained earnings, not the beginning and not the dividend. We have used those two information in the statement of retained earnings. So we just need the ending retained earnings, which is this, 26,400. And we plug it in here. And you can see liabilities plus stockholders' equity, 55,250, and it matches our total asset, 55,250. That's how you prepare your balance sheet. So we've successfully prepared the income statement, the statement of retained earnings, and the balance sheet. Now we need to prepare the statement of cash flow. This is different. Remember, I said the second portion of the information we're given is for the cash flow. Why? Because I could easily say cash received from, cash paid to, cash paid to, cash received from, dividends paid to, anything paid, received in terms of cash goes on your cash flow statement. And you can also label that in advance. There are three activities for cash. They are either operating activities, our regular day-to-day activities, or they are investing activities, long-term projects, long-term investments, or they are financing activities. And so you can categorize each of these based on what they are for. Issuing common stock, those are owners, right? We are getting money from them. We are giving them share certificates. So we are trying to obtain finance by issuing shares. That's a financing activity. Cash paid to purchase equipment. Equipment is a long-term asset. And anytime you are spending on a long-term asset, that is an investment. So that's an investing activity. Cash paid to suppliers. Oh, without your suppliers, there's nothing to sell. There's nothing to manufacture. So this is a regular routine activity. That's operating activities. Cash received from customers. No customer, the business is dead. So operating activities. Cash received from sale of long-term asset. You buy long-term asset, that's an investing. When you sell them too, that's an investing activity. This is an investing activity. Dividends paid to stockholders. Now you're paying dividends to the owners of the business. Why? Because you got money from them in the first place. They are the owners. They must have contributed to the ownership. So dividend paid to them is financing activity. So what I do, since I've labeled them, easily segment your statement of cash flow into the three different activities. Operating activities, O. So look for O. We only have O for these two. So we have cash received, and I have it here. Cash paid to suppliers. And so we have a difference, a positive difference of 2,750. That means we made actual cash, not just money in terms of income. We made actual cash positive in the previous year. Our investing activities, cash received from sale of long-term assets. Cash received from sale, those are long-term assets. And so when we now sell them, we are getting a return, we are getting back from what we've paid initially. So that is an investing activity. And then when we actually buy new equipment, that's an investing activity. Cash paid to purchase equipment. Cash financing activities, the F's that I have there, cash received from issuing common stock, and then dividend paid to shareholders. Take note that when you have a cash inflow of cash, that is positive. And when you have an outflow of cash is leaving the business, you're paying out. That's a negative. That's an outflow. And that's how you see the positive sign, the negative sign here because it's paid. Positive here because you receive cash. Negative here because we paid cash. Positive here because we received cash. Negative here because we paid cash. And that leaves us with a net change of $3,230. When you add that to the beginning cash, this is a reduction, right? So when you reduce the beginning cash by that change, you have 10,600, which if we want to verify, we see that it matches our cash in the balance sheet. That's what we want to do. This is a form of reconciliation. It helps us to be sure that our balance sheet is good. That that's what it does. Let's answer the remaining questions. Was the company profitable? From the word profit itself, you remember that there used to be a statement called profit and loss account. Profit and loss account is what became our income statement. And so, automatically, for you to know if the company is profitable, you have to go and look at something that has to do with income. So you have to look at the income statement. That's where we have to do. So where did you find this information? Well, you can answer that before you even know whether it is profitable. You can only find it in the statement that talks about income. And so when you look at the income statement, you have a positive net income, right? So that means we made money. That's a gain. That means we made something. So the company was profitable. That's the answer to that question. And the information could be found in the income statement. Number 3, what proportion of profit is paid as dividend? Which financial statement provides this? So you have to look at which financial statement has dividends and talks about profit at the same time. There is no dividend in the income statement, right? So we can't, even though it's talking about profit, but we can't say income statement because there's no dividend there. So which statement includes dividend and profit gives us information about this? The statement of retained earnings. The statement of retained earnings tells us how much dividend is being paid and how much income was made. You see that the ratio is like we are even paying dividend that is more than the net income during the year. That's what it is. There is less, the dividend is more. So this reduces our retained earnings because we paid out more than we earned this year. That reduces our retained earnings at the end of the year. What other question do we have? Which groups of users are the major source of financing? Which group of users are the major source of financing for the company? Are they creditors or are they stockholders? Where do we get that? Which statement would tell us that? Liabilities, creditors, who are liabilities, or stockholders. Which one is the major source? The statement that puts together these two things is the balance sheet, because the balance sheet is the basic accounting equation, right? So the balance sheet is telling us, let me pull it to the balance sheet, that assets equals to liabilities plus stockholders equity, right? So that helps us, because now it's saying who is financing this company the most. These assets, 55,250, who owns most of them? Is it the owner or the borrowing, the lender? And we can see the total liabilities is what? Is less than 15,000. This is 13,007 something. That's the total liabilities. And the stockholders' equity is 15,000 plus 26,000, that is 40,500, 41,500. So that means the stockholders' equity is way more than what we borrowed. So the major financier are the stockholders, are the owners of the company. They are the ones who are financing the company in a major way. Let's go back to the questions. Did cash increase or decrease, and by how much? We can see that easily. We can look at the balance sheet for that, but you only see the cash at the end. That doesn't tell you much unless you actually look into the cash account. But for you to know that the cash increased or decreased, simply look at the statement that talks about cash. The statement of cash flow. The end of this statement is the net change in cash. You easily see whether your cash increased or decreased. In this case, what did it do? There was a negative change in cash, right? So that means it decreased. It decreased by 3,230. 3,230. That's the decrease in cash. That's the decrease in cash. Then it says, which financial statement? Of course, the statement of cash flow. If you have any question, please feel free to reach out to me via accountingsimplified@gmail.com. Accountingsimplified@gmail.com. I mean ACCTING simplified@gmail.com. You can also book a personal session or a group session. Go to accounting-adura.com. Accounting-adura.com. And we'll